Exercise 6.9, which you were not asked to do, requires that you perform the transactional analysis using perpetual inventory. Exercise 6.17 refers us back to the information from 6.9 on page 307 and says, assume that we are now using periodic inventory and not perpetual. So let's take a look at these transactions. On May 2nd, they purchased books on account from Readers Wholesale for $3,300. The terms are 110 net 30. Well, this goes to purchases of $3,300 and accounts payable $3,300. We might want to make a note that our terms are 110 net 30. If this was the perpetual method instead of purchases, the debit would have been to inventory. Now they pay cash for freight costs of $200. So we have $200 freight in, $200 credit to cash. Had this been perpetual inventory, this $200 instead of freight in would have been added to the inventory cost. Next, on the 5th, they returned books that cost $400 because they were incorrect. So we're going to reduce our accounts payable by $400. That stays the same, but instead of reducing our inventory directly, we're going to credit an account called purchase returns, and that reduces net purchases by $400. Then on May 10th, we're going to pay what we owe them. Well, we owed them $3,300 minus the $400 that we sent back. That's $2,900 plus, or actually minus, we get a 1% discount because we're certainly within the 30-day period. So that's a debit to accounts payable for $2,900 for the entire amount. It's a credit to purchase discount, $29, 1% of what we owe them. And we're going to pay our cash of $28.71. 29 minus 29, $28.71. Now, on May 30th, we're selling all the books that we bought for $4,000. Well, that's a debit to accounts receivable and a credit to sales revenue. Notice nowhere on this page do we ever get anywhere near the inventory account. This is periodic inventory. We'll get near the inventory account at the end of the period, at which point we will close purchases to cost of goods sold into inventory and returns, etc. The next thing it asks us to do is to compute the purchase returns and the cost of goods sold and all that good stuff. Okay, so this is the year-end adjustment. So that's what we have to do now. So our cost of goods sold is $3,071. $3,071. How the hell did you come up with that number? Well, I'll tell you now that you've asked. We purchased $3,300 worth of books. Remember? We sent $400 back. That's $2,900. Then we paid freight of $200. That takes us up to $3,100. Takes us up to $3,100. And we had a $29 discount for prompt payment, hence $3,071. I'll admit, you would have had to do some real fussing to come up with that if I hadn't walked you through that. Okay, purchase returns, they just flat out give us. They told us we sent back $400 worth of stuff. So we're going to put that down, $400. Our purchase discounts was $29. Our purchases were $3,300. And our freight in was $200. Everything was given to you except that, and admittedly that would have been a bit of a bear to come up with.